Hey everyone. So today we're going to build a discounted cash flow model for Chipotle. And we're just going to pull the numbers directly from the financial statements, plug them in, and then we're going to be able to simulate different scenarios, a bearish case, a bullish case, and we'll get a price range for how what the prospects for the stock are. We're going to we're going to build this completely from scratch, and I'm going to talk you through it basically. Actually, I won't be doing that much talking; it'll just be watching me type, I guess. But yeah, without further ado, let's get cracking. So we're going to pull the financial statements directly from the 10K and the 10Q. This one is for the first 6 months of the year. Um, and we'll pull those numbers from there and we'll build it straight into the model. And just a quick, how's the share price doing at the moment? The share price is just under $42, 41.91. Over the last 5 years, it is up significantly, but it did hit a peak of, well, a double top of $65 before coming down to where it is today. It first crashed when they changed the CEO because he left to go to Starbucks, and then it's been on a trending decline ever since. So let's find out what the intrinsic value of the stock is and see whether there is any upside or potential downside to it. So we'll start with a 10K because that's going to be from the historic figures from 22, 23, and 24. And what we need to find are, where is it? The financial statements. So this is the balance sheet, and this is the income statement. And what you can see is it does break down revenue into two product segments, the food and beverage revenue and the delivery service. And you can see that basically pretty much all the revenue is coming from the food and beverage segment. Also, as well, when we're building things like the WAC, Chipotle, the vast majority, like 99% of its revenue comes from the US. So we will treat it as a purely US company when doing this. So what we want to do on the spreadsheet, the first thing that we like to do is, so page layout, and we take off the grid lines. This just makes it a bit cleaner. We need to freeze the first column. Actually, okay, let's delete this one. We freeze this and we insert another. And we'll make this one a bit bigger and we'll put this a lot smaller. And what we want to put in this first one at the top is, so let's just put CMG because that's the ticker, and we can go stock. So it just takes a little bit of time to load sometimes. Come on. There we go. And this is going to allow us to have the live prices, live market cap, and anything else live that we need. There we go. And what we want to put here is ticker, and we want the date, and let's just make this a different color. Actually, I know what we need to do first. We go, we want to put the ticker symbol, CMG, and the date is the 29th of the 8th, 2025. And let's just make these into a bit of a different color. We'll put a border around it. And then we're going to want the current price, the implied, and we need to see if that will give us any up. down. We'll take this formatting, put it there, and we can go here, and this is going to equal Chipotle current price. And we can leave these two for now because we need to get the implied price after we have built it. So, yeah, let me just move this one out of the way. Center there, and we can go. We just need to go up to about K, I think. And let's go assumptions. We'll just change the color so that we know it's a heading. Fine, go to white. And here we're going to go revenue segment. And this is going to be how we switch between different scenarios. We can see here that it's food and beverage, delivery service. The other is the other one, and then that is going to be, we go switches, we go bear, we take, and we can make this bold as well. We go EBIT, WACC, that's the weighted average cost of capital, and TGB is the terminal growth value. Oh no. And in these, we just leave it at 2 on the base. No, it's not a date. Then we can go now. You'll see what these means when we come to the end and we're simulating different price scenarios. So now that is done, let's start building the revenue. So we're starting with 2022. We go right through to 2030. We go food and beverage is the first revenue segment. And below that, we want to know what the percentage growth is each year. Then we're going to go bear, base, bull. We can also look at, it doesn't really matter for this one because food and beverage is the majority of the revenue anyway. But if we're looking at other companies, sometimes it's nice to know what the segment as a percentage of total revenue is. Delivery, oh no, sorry. What you want to do is go to, is at least keep it dynamic so that if you change one, it changes all. And then, yeah, we can just take this down. So for food and beverage, we can see that this is going to be in USD thousands. So yeah, as you can see, it's in thousands. If you were looking at something like Apple or Nvidia, this would be in millions. So let's start with, okay, 2022, it's 8558.01, and we just need to make this let's make it cleaner, and then we can format throughout, and we can do this. Ooh, sorry for using the mouse. 384. We go, and this will, we can take this right up to here. Then we look at the delivery service. We can see so the delivery service revenue is what Chipotle do as their own delivery. The majority of their normal delivery is through third parties such as DoorDash or Uber Eats, but this is their own one, which they probably use for um, the restaurants that aren't, say, in big city hubs where they have DoorDash and Uber Eats, etc. So then we need the 2025. So we have to go into the half year statement, well, the 10Q, and we can see that up here. And for half the year already, um, it is 5.9 billion in revenue. What we no, actually, well, sorry, one second. This should be millions. So yeah. So this is million. This is obviously, I mean, sorry, I was a bit slow. 11 billion in revenue. So it's done at the moment 5.9 billion in revenue. So if we say this is for the half year, we double it, it should be near 12 billion in revenue. But if we take 2024, so the total revenue for 2024 was 11.247 billion. And halfway they had done 5.638 billion. So it did quite reach double by the end of the year. So if we just take that and we divide it by 5639, we get 1.99. See, okay, let's just multiply it by 2. Let's not mess about. No, oh, no, 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 sorry. That needs to be multiplied by 2. There we go. And now we've done I mean, sometimes you can go further back and add more historic figures, but for ease of today, and obviously to have it all on the screen, let's just go back for the last 3 years. Da, 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 da. And let's just find out what the total. Let's just make sure the total revenue looks good. I just need the border. Da, da. Go total revenue. And this is going to be the sum of the delivery service and the food and beverage. We'll just make sure they match up. Yeah, that's that's about. And this can, we just copy it down, so it will auto-complete as we're going along. Oh, sorry, I forgot this one. So 35, well, so what would that be? So let's just do 60 divided by 35, 1.89. So in 2024, the total delivery service revenue was 66 million. In 2024, yeah, it was 66 million, and by halfway they had 35 million revenue. So it didn't hit the 2x. So it's 1.88. So let's just do 31 multiplied by 1.88 to get a figure for the rest of this year. And yeah, and this is declining and will probably trend towards zero, and that's what we will forecast. So let's just get the percentage of. We'll just do it to there for now, so we don't get any errors. There we go. And then now, what we will do is we need to find the average of these last 5 years, and we'll say, okay, 11%, and we have to forecast what we think the next few, well, what 2030, what we think the growth rate will be then. Let's call it 10%. Let's make it steady, because these two are, you had two 15%, and then now it's down to 5. So let's say it stays steady at 10%. And the delivery service will put this down to 0% growth, because it will get phased out. And the way we do this now is we take, okay, this, this is for later, but add a 1 there above 2026. And we'll understand later, but it can also be used for this as well. But let's go. So we want to work out what these next few years are going to be so that they smoothly go down from 11 to 10%. So we're going to take the first year, with the first year subtracted by the final year, divided by the 5th year, take away by the first. So I'll just say that again. So you take the first year and we minus, in brackets, the first year minus the final year, close brackets, divided by the final year, 2030, minus the first year, which is 2026, of what's being forecast. And what we want to do is we want to lock in where it's K25 and K20. Why is it a date? And then this gives us, and let's just, we'll do it for all of them actually. We'll just increase the decimal places so that we can see the differential. Wait, whoa, why is that not working? That's why. Actually, we can just format it this way. There we go. And we're going to say, so if we think on the base case, the final year in 2030, the revenue growth rate for food and beverage will be 10%. If we say a bullish case, it's not going to be, I mean, we'll go for the bullish is, okay, let's say it's 10% higher than that 10%. And the bearish case will go with 90. So if we take, so for the bearish case, we take the 11.4 and we multiply it by the 90 on the bear case, and that gives us a 10.3% growth rate in the bear scenario. And we do the same for the bullish. We just remember to lock in this because it's the same cell that we're multiplying for all of them. And what we do now is we go use the offset function, G23, the switch, which is C10 here. And this gives us the growth rates that we can switch between as we are simulating. So I'll do that, and then I'll show you how it works. So to get that, we take the previous year and we multiply it by 1 plus the growth rate. So in this case, we take the 11 billion, well, yeah, 11.8 billion multiplied by 1 plus 11%. And that way we can just go like this, boom. And I'll show you how the thing works. So let's go on the bear case first. And as you can see, the revenue goes down and the growth rates go down. Then we go base. See, it comes back up and it comes to what it is on the second row. Then we go on the bullish. And yeah, as you can see, that we can go through the different scenarios, but we'll leave it on the base case at the moment. For this one, I think honestly, I think we just leave it as 0 for all of them. It's such an insignificant part of the revenue of the revenue that we don't really need to focus too much on it. So, but we'll still go through the same process because we have to average these down. We can take this one, come here. Let's just make sure we need to be 32 though. No. So this needs to be minus G20. Yeah, perfect. Okay, well, let's give it a so a bear. I mean, we actually have to do this the other way around because if we do, the bear needs to be 105% because it's a negative number. And now this is how we'll be able to calculate. Okay, What do I want to do now? Yeah. Lock it in so that we can just copy and paste it. We do the same for and again we can just copy this down to here, change it to C11, and that should and then we just go so the idea is that this is it that the delivery and service revenue is going to be probably be phased out and only done in certain areas, as I said, that they can't get an Uber Eats or DoorDash. So yeah, the main thing that we just focus on is the food and beverage side. So let's make this bold so that we know. So now what we do is we focus on the income statement. And the income statement for the DCF consists of the revenue, which we can just pull it straight from here, and we go all the way down. We make sure it's equal so that when it's being simulated, it will move dynamically if we change the switches. We Then we bring in the EBIT, which is the earnings before interest and tax, and that we need that to. And then we have taxes at the bottom, and we need that as a percentage of EBIT. So let's go back. Okay, we can do this 2025 first. Let's do the other one first. So what we're going to do is we take the EBIT as being as this line, the income from operations. So for 2022, it was 1160.403. Let's reformat it so that it looks nice. 1557.813 for 2023. 1916.3334. And we and then for taxes for 2022, we can see that here 282.4, well, yeah, 282 million in taxes. 391. So the tax rate this year is about just over 24%, and that's holding fairly steady over the last few years. Let's now have a look at the income from operations for the first 6 months of the year. No, so I mean, it's possible that it does nearly. So what would we call that? If we look here, the 2024 1027. So if we take divided by 1027, 1.8. Okay, well I'll do this as, let's say it does 1.88 on this 1038 figure. So yeah, I mean, even though the revenue's higher and the EBIT is higher, the margin's slightly lower. So let's do a quick. This is not going to be our full forecast for the EBIT, but this is just to, well, just fill out the lines basically. And we take this and we take the revenue and we multiply it by the EBIT. Then the taxes for, so again, if we take 476 divided by 253 point, sorry, 1 second, we'll do it like this, divided by 253.6, 1.8, let's do 1.88. 256.189 multiplied by 188. So yeah, so I mean, again, it's about 25-ish% tax. And it is mostly, I mean, yeah, as you said, it's like 99% of the revenue does come from the US. So that's where the tax is paid mostly. Then we do, to forecast future taxes, we take the EBIT, multiply it by the tax rate. Yeah, okay, perfect. So now what we want to do, now we have all of that, we want to go on to the cash flow items. And these include depreciation and amortization, but we'll call it DNA. And we need the percentage of revenue there, percentage of CapEx. And CapEx, capital expenditures. And these we find on the cash flow statement, which we'll go on to in 1 second. Change in net working capital, percentage of Let's make it slightly bigger so that we can see it. Okay. Let's go start with the older years first. So we can see here depreciation and amortization for 2022 was 286.826. Well, again, let's just $287. Then we have 319.3. Well, Then we have 335. And we will get this as a percentage of revenue. So the capex is under this under the purchases of leasehold improvements, property and equipment. Four seven nine 164. The next one 560. 593.603. And let's divide by whoops. The so this means capex is significantly more than what is being depreciated. Now this one always is a bit painful to do, the change in net working capital. And what we do is we add all of these together. So some of it's negative, some of it's positive. So we add all of that together, and that will give us the change in net working capital. So yeah, let's go. 6. If you don't pay attention, this can really stump you up. What would the typo be? 78. I mean, that's the right answer from when I did it before. So yeah, okay, that's okay. Again, so we're doing this column now, 2023. I have to not talk because I need to concentrate. There we go. Now we move on to 2024, which is, yeah, let's go. Almost done now. Actually, no, we've got 2025 to do as well. Now, okay, well, let's just get what this is as a percentage of revenue. You can zoom in a bit more as well if this is more helpful. Then we need to go, okay, 2025. Again, no, no. Let's just have a quick look at what 2024 was. So 335 divided by this 166.8. So 2, yes, yeah, just it's about 2. If we'll go with that. 156 multiplied by 2. Oh, yeah, we haven't done the capex yet. That's why. So again, here, we just have a quick check, see how it did relative to the half year. 273.193. So 2.17. Okay, so it did actually, the second half of the year, their capex was more than the first half. So we'll go 305.395 multiplied by 2.17. Okay. Now, so change in net working capital. That is going to be, what we'll do is we'll just do the same again, but we'll multiply it by 2. So 39.946. Yeah, so make sure you add a bracket at the beginning of this because 0.362, 12.360 minus 24.689. I think in the future I'll find a way to make these more compelling. But I wanted to do it from scratch so that you can look at the whole process, make sure we don't miss any step. Then we multiply it by 2 to give us the full year. And yeah, it's about 70. That's what I got in my trial run. So yeah, I'm happy with that. Now, to forecast what each of these cash flow items is going to be going forward, we just take the average from the previous years and we multiply it by the revenue. We do the same. Ideally, you want to be doing these at the end of the financial year so that you can use full year numbers rather than having to estimate what the rest of the year is. But this is more, it's about methodology than full accuracy at the moment. But we should always try and be as accurate as we can. Okay, that is the cash flow items now done. Let's build the DCF. It's going to feel like there's a lot of repetition, but there is a meaning to it and a purpose. So DCF. The first thing we have on the DCF is, again, the revenue. And we do exactly the same again of what we've just outlined. We make it equal to what the revenue was at the top. So that was C42. And we go down, -1. We've pretty much done with the statements, but we do need to, when calculating the weighted average cost of capital, we do need it for the debt to understand, and well, also what the cash is as well. But yeah, otherwise we've got the main figures that we need. All we really needed are obviously the revenue, the EBIT, the taxes, the depreciation, amortization, the capex, and the change in net working capital. So now let's EBIT, but we're going to do something a bit different with the EBIT now. We're going to case equals 45. We do this up to what we've recorded. We do, but then we're going to add in a switch for it so that it can be, we can make it go up and down. Up is bullish, down is bearish. Let's just pull it from up here. Oh, 1 second. Let's give it a couple more. Just, it's not vital, but it just makes it look a bit cleaner. Ooh. So we're going to be doing these again. Once you get the hang of these, they can be quite therapeutic to build. You just go through the motions, and it's yeah, it's quite good. If we say, I mean, 16.5. Let's call it 16.5. What we think the base EBIT is going to be. G13. Remember that number? Or cell. Remember that. It's done for me. I think it's going to stay fairly stable. Let's put it as, the downside is it's 95% of 16.5%, and the upside is it's 105% of 16.5%. So, I mean, equals multiplied by E13. And this one will be multiplied by I13. Then we go G69. The switch for the EBIT, lock it in, then 0. I don't know what happened there. That's better. Sorry, I was seeing that at the very bottom of the screen. I'll move it up. For now, I guess we can make this a bit bigger. Nope, it doesn't want to move. Sorry, there we go. So we have the EBIT, now we need taxes. And that's going to be a percentage of EBIT again. Oh, I need to put in bear bull. The taxes will be and the good thing is we can let's make this a bit bigger. If you want to see, I mean, it's a bit, we can, if you remember this figure, this 2166, we put it into a bull. You see, it goes up to 2275, changes the tax rate as well. Actually, no. This is not right. Down here, what we need to do is to go average. We multiply this one. And then this way the tax can change as we are. There we go. Yeah, perfect. Then next, we work out what the EBIT is, which is the earnings before interest, but after tax. And the way we do that is we take the EBIT, and we subtract the tax. It's that simple. And we can bold it, and we take this all over here. Let's just put it back onto the base case so we don't get confused. And then we need the DNA, the capex, B60. Now what we do is we are able to calculate our unlevered free cash flow. Let's pop a border in. We go un. So the way we do that is we take the EBIT, we add back in depreciation and amortization because it is a non-cash expense. We subtract the capex, and we subtract the change in net working capital. And that gives us 1.188 billion in free cash flow for next, well, is forecast for next year. And yeah, we just simulate out until 2030. Now we want to find the present value of the unlevered free cash flow, so the PV of UFCF. And to do that, we need to build a WACC, a weighted average cost of capital. Pull this. DCF, and again, for aesthetic, let's take the grid lines off. Go back to home. We can just go, we can put the data in. Oh, I always forget to put the ticker. Come on. Oh, sorry. Nope. Okay, now what we need to do, the WACC equals the percentage of equity times the cost of equity plus the percentage of debt times the cost of debt times 1 minus the tax rate. So let's go. Market cap is going to be okay. Yeah, what we need to do is just for formatting, divide the market cap by 1 million. There we go. Then we have the percentage of equity, which we don't know yet because we need to know what the debt is first before we get to that. The cost of equity, cost of equity. Let's just make this a bit. And that is the risk-free rate plus the beta times the equity risk premium. And the risk-free rate is the US 10-year, which is currently 4.23%. The beta for this one, for the restaurant and dining industry, we're not going to use what it's relative to the index, index, because it's not very accurate, especially if it's say over 5 years and it's done on a monthly monthly candle. What we'll do is we'll do the beta as Professor Aswath Damodaran does. He lists out his betas by industry, and for the restaurant and dining, it's currently 0.86, the average unlevered beta. So we'll use that. And the equity risk premium for the US, remember, this is the majority of revenues are coming from the US, 99% of them. So we'll just keep it at that. Let's not overcomplicate things for now. We can do that on future valuations when we're looking at genuinely like properly global companies. So we have that. So what we do now is we go, actually, this might be a bit small. Let me zoom in. Sorry about that. So yeah, as we said, we take, to get the cost of equity, we go equals the risk-free rate plus the beta multiplied by the equity risk premium. And that gives us a cost of equity of 8.28%. And let's just make these a bit Yeah, it's better so that you can see. Now, for debt, so Chipotle doesn't really have, it doesn't have debt in the traditional sense, but it does have a lot of, what would you call them? Let me pull up the balance sheet. So it has a lot of, so yeah, long-term operating lease liabilities and the current operating lease liabilities. So we'll use this as the debt, and that is 4.781 billion. Sorry, 4.781 billion. Why didn't I put my? That's what I wanted. And that figure is basically taken by taking the current operating lease liabilities, 277,836, and we add that to the long term, 4.262 billion. So yeah, that will give us. I'll show you even now. We go 277.836 plus 4.262.782. Oh, I got it wrong earlier. Maybe I've got it wrong now. I do have it wrong now because it's on the wrong sheet. It's this one. We need the balance sheet on this. So yeah. So yeah, 287,252. 287.252 plus 4,493.334, 4,781. Yeah, I was right. And so we need percentage of debt, but we don't have that yet. Actually, we sort of do, but we'll do the cost of debt first. And this is because it's not debt in the traditional sense. What I've found is at the end of this, what the interest, well, yeah, the discount rate for it, which means we can, where is it? We can use that as the cost of debt. Here we are. Yeah. We'll use this one. I can't find a figure for what it is mid 2025, so we'll use this 5.3% as the cost of debt. And they actually tell us is it going to be there? There's an effective income tax rate it actually says as well. We can use that on this one. If not, we'll just use 24%. So for the 6 months, well, 23.7. And so the total, when you add in the market cap plus debt, is just under $62 billion. And so the WACC, if we remember what that is, it's equal to, actually, no, because we need to know what the percentage of, so the percentage of debt is the debt divided by the total, and that is going to give us 7.71%. And we do the same with the market cap to work out what the percentage of equity is. And that's 92%. So now let's work out the WACC using this formula, which is the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. Oh, and that gives us a 7.95% whack. Put this back to 10. And we can plug this in now. So we go back to the DCF. The whack we can say is and if we were going to go as a bull, we would, on a bullish case, we would say minus, because a lower whack is better for free cash flow. Point. Yeah, that's good. And then if we were going to go on a bearish, we add 0.5%. Because the higher whack, it's a higher risk rate. And we're going to use 2.5% as the terminal growth value. And we 0.5%. And this is once after the 5 years, we're going to expect it in perpetuity to grow at 2.5%. There we go. And we go down here afterwards to the whack, to the second whack box, choose, and we say select these four in the correct order. No, that didn't work. Let's do it again. Oh, I know why. I know why. We need to format it so it looks like that. Perfect. We do this. Perfect. This is looking good. So, to find the present value of the unlevered free cash flow, we take the unlevered free cash flow and we divide it by 1 plus the whack to the power of whichever year out we're projecting, which is why I said let's put these 1, 2, 3, 4, 5 in earlier. And let's lock the whack in because we want to doesn't need to be bold. There we go. Then we're going to find the terminal value. And that is done by taking the unlevered free cash flow, the final year of unlevered free cash flow, and we multiply it by 1 plus the whack, and then divided by the whack minus the terminal growth value. And that gives us a terminal value of 35.5 billion. Just format it. And we want to find the present value. So let's do that. The PV of TB, the present value of the terminal value, is going to equal the terminal value divided by 1 plus the whack to the power of the final year, which is number 5. And now we have that, we want to find the enterprise value. And this is done by taking the sum of the present value of the terminal value plus the sum of the present value of the unlevered free cash flows that we forecasted. And so this gives us an enterprise value of 30, just over 30 billion. Then we're going to add cash minus the debt to give us an equity value. The cash, let's look on the balance sheet, is 6 months ended. It's at the top, I think, the balance sheet. So yeah. So yes, so let's go 844 million in cash. So 844.524. And the debt, we know because we've just done that on the WACC, 4.78 billion. So now we can get the equity value. And that is the enterprise value plus the cash minus the debt gives us the equity value. Then we find the diluted shares outstanding, and that is on, okay, so it usually tells you what all the shares are, but we want the diluted, and that is here. So let's go on the 6 months ended, 1355.478. And now we have our implied share price because we just, sorry, let's pull this up a bit. This does not look good, does it? $19. It's quite a drop from where it is now. That's nearly a 50% drop. So what's that? K99. Ooh. Sorry. Excel always thinking everything's a date. Well, I did. Yeah. I did put it in as a date earlier when I copy pasted, but okay. Yeah. So look at this. On a base case scenario, it looks like Chipotle is should be 54% less. Let's look at what the different projections are. If we've gone let's look what the bull case will be. So 27. And you know what? That's not too far from where it was hovering. Where was it? Down here. Yeah. So it's sort of, yeah. I mean, the bull was sort of the bottom before. I mean, for it to get to, on a base case, based on where it is now, let's go 50%. Wow. So I mean, it would have to be insane revenue growth to get to what the market is valuing it at the moment. Yeah, so that's it basically. That's the discounted cash flow built. It's this Chipotle because it doesn't have many revenue segments and it's a predominantly US company. This wasn't too too difficult to build. We will do more complex ones later, and I'll try and get better at teaching as well. But yeah, thank you very much for watching, and I hope you found it useful. And we'll see you on the next one. Thank you very much.